What are the implications for the economy in the short term? The current recovery started in mid 2009. Since then, real GDP has grown at a 2.2% annual rate. Now, despite a negative first quarter caused by weather and inventories, the economy is picking up some speed, and we expect 2.5% to 3% real GDP growth on average in the year ahead. The big plus for faster growth is that government spending as a percentage of GDP is falling. It's down to 20.3% of GDP in fiscal year 2014, the lowest since 2008, and down substantially from the peak of 24.4% in 2009. Government spending is still a drag on the economy, just less of one. The continuing sequester, an end to extended unemployment benefits, and tapering by the Fed are all signals that the tide may have turned. Smaller government means a bigger and more vibrant private sector. The unemployment rate fell to 5.9% in September, and weekly initial claims for jobless benefits plummeted to 264,000 in October, the lowest since the year 2000. The labor market is still far from its full potential, but layoffs are few and far between. Let's consider the specifics, starting with retail sales. After a very solid report out of the retail sector in August, consumers took a breather. Retail sales fell 0.3% in September, led by a decline in the very volatile auto sector, which was expected. But even outside of the auto sector, retail sales were down 0.2%. Gas station sales were a large culprit, falling 0.8% in September as oil prices continue to drop. Prices at the pump on a national average are now down 4.5% from a year ago. The widespread use of fracking and horizontal drilling is making this possible, which means consumers can take the money they save on filling their tanks and spend it on other things. It's important to remember that even in the best years, retail sales still fall in 3 months out of the year, so the decline in September, coming on top of the very strong August report, is not something to worry about. Overall, retail sales still remained up a very healthy 4.3% from a year earlier. Core sales, which exclude autos, building materials, and gas, were unchanged in September and were up at a 4.3% annual rate in the third quarter versus the second quarter average. Consistent with an expected rebound in the fourth quarter of 2014, U.S. consumer sentiment rose in October to the highest in more than 7 years, boosted by views on personal finances and the national economy. The Thomson Reuters University of Michigan preliminary October reading on the overall index of consumer sentiment came in at 86.4. The data show absolutely no signs that fear and panic is about to overtake the consumer sector, despite broader concerns about the global economic meltdown, escalating military conflicts, and rising concerns about Ebola. Industrial production soared 1% in September, easily beating consensus expectations. About half of the gain was due to strength in utilities and mines, which are very volatile from month to month. But manufacturing output grew 0.5% despite a 1.4% drop in the auto sector. One measure of the underlying trend is that the non-auto manufacturing sector, which climbed 0.6% in September, has not dropped in any month since January and was up 3.5% from a year earlier. We expect continued growth in the industrial sector. According to the ISM Index, the manufacturing sector was still growing at a robust rate in September, just not quite as fast as in August. The index, which measures factory sentiment around the U.S., came off its highest reading in 3 years to a still healthy 56.6 in September. Zigs and zags are to be expected, and no one should see the report as a sign of economic weakness. Both the 3- and 6-month averages for the index are the highest in more than 3 years. According to the Institute for Supply Management, an overall index level of 56.6 is consistent with real GDP growth of 4.4% annually. While the GDP report came in at a strong 4.6% for the second quarter, the ISM report has tended to overestimate real GDP growth in the past several years, and we're projecting growth of around 3% for the rest of the year. In related news, purchases of durable goods like airplanes, cars, and heavy machinery that is designed to last at least 3 years fell by 1.3% in September from the prior month to a seasonally adjusted $241 billion. But excluding the volatile transportation category, orders fell just 0.2%. On the positive side, exports increased faster than imports in August, with the U.S. trade deficit shrinking slightly to $40 billion. As a result, it now looks like net exports will add about a full percentage point to real GDP growth in the third quarter, consistent with our forecast that real GDP grew at about a 3% annual rate in the third quarter. The best news in the August report is that the total volume of trade, imports plus exports, hit a new all-time record high, underscoring continued improvement in the U.S. economy. Over the next few years, higher energy production in the U.S. due to hydraulic fracturing and horizontal drilling, along with seismic imaging, will continue to transform our trade relationship with the rest of the world. 9 years ago, back in August 2005, the U.S. imported 11 times as much petroleum product as it exported. Since then, petroleum product exports are up 602%, while imports are up only 23%. So now petroleum product imports are only 1.9 times exports. Finally, policymakers are helping this trend, with the Commerce Department giving 2 companies permission to ship a type of ultralight oil known as condensate to foreign buyers. Given the huge glut of oil in the Permian Basin in Texas, we expect more moves to allow exports over the next couple of years, and for oil prices to keep trending lower. As a result of both the pre-existing trends and new policy direction, we expect the U.S. to move to a petroleum trade balance and perhaps even surpluses in the next few years. As with the manufacturing sector, the ISM service sector report suggests growth remains strong in September, but at a slightly slower pace than in August. Even with the dip in September, the 3-month average for the index showed the fastest pace of service industry growth in nearly 10 years, and the index remained above 50, signaling expansion for the 56th consecutive month. The business activity sub-index declined 2.1 points in September to 62.9, the second highest reading of the past 3 years. The employment sub-index ticked higher in September to 58.5 from 57.1 in August, the highest reading we've seen since the start of the recovery. As employment continues to expand, expect income growth to boost consumer spending and business revenue, which in turn will help support even more job growth in the future. In other words, the growth in the economy is self-sustaining and should remain that way until monetary policy gets tight, which is at least a few years away. What about housing? U.S. housing starts and permits rose in September, a signal the market's recovery is supporting what appears to be growing strength in the broader economy. Groundbreaking rose 6.3% to an annual pace just over 1 million units, the Commerce Department said. The average 30-year mortgage rate dropped in October to its lowest level since June 2013, and the level of housing starts is not far from a 7-year high. New housing starts for single-family homes, the largest part of the market, rose 1.1% in September, while the more volatile multifamily home segment jumped 16.7%. Permits advanced 1.5% to a just over 1 million unit pace. In other housing news, it looks like we're finally getting a thaw in mortgage lending. New single-family home sales rose 0.2% in September, coming in 17% higher than a year earlier and at the highest level in more than 6 years. Nonetheless, new home sales still remain at depressed levels relative to where they should be by now in the recovery, and we believe there are 3 key reasons for this. First, the home ownership rate remains depressed as a larger share of the population is renting. Second, buyers have shifted slightly from single-family homes, which are counted in the new home sales data, to multifamily homes, which are not counted in the report. And third, although we may be seeing a thaw, financing is still more difficult than it has been in the past. The inventory of new homes rose 3,000 in September, but still remains very low, and most of the inventory gains are from homes not started instead of homes completed. As a result, home builders still have plenty of room to increase both construction and inventories. Meanwhile, existing home sales look like they're bouncing back. Sales increased 2.4% in September, have risen in 5 of the last 6 months, and are now the highest in a year. Although overall sales are still down 1.7% from the year earlier level, this masks a huge change in the composition of existing home purchases that bodes well for the future. Distressed homes, including foreclosures and short sales, now account for only 10% of sales, down from 14% a year ago. All cash buyers are now 24% of sales versus 33% a year ago. As a result, non-cash sales, where the buyer uses a mortgage loan, were up 11.5% since last September. So, even though tight credit continues to suppress sales, we are seeing early signs of an easing in mortgage credit, which suggests overall sales will climb in the year ahead. Another reason for the tepid recovery so far in existing home sales is a lack of inventory. Inventories were up 6% from a year earlier, but down the past 2 months. In the year ahead, we expect higher home prices to bring more homes on the market, which should help generate additional sales. Either way, whether existing home sales are up or down, it's important to remember that these data by themselves should not change anyone's impression about the overall economy. All in all, it looks like the tepid recovery continues, while our economic institutions slowly adapt to the new digital paradigm.